more. I'm joined by Ted Rossman, Senior Industry Analyst at Bankrate. He's here on set with me along with Hennessy Fund's Neil Hennessy. We talked about this earlier, Neil, but you've brought your top consumer picks. So welcome to you both. Ted, first of all, give us the landscape. It seems like one day we hear that the consumer is still strong by a variety of metrics, and then the next day the picture doesn't sound as good.
This is the nature of the economy right now. Yeah, we have all these ups and downs. I thought bank earnings recently were pretty positive about the state of the consumer and delinquencies. And I feel like normalization is a term that people keep throwing out there, as in back to 2019 kind of levels for delinquencies after being artificially low. No doubt inflation and high rates are squeezing people, but I think people are hanging in there. Consumer spending's been remarkably resilient.
Although consumer sentiment has been quite poor. And you see that's where the fact that inflation remains high and that their, real purchasing power is being eroded, that seems to still be having an impact. So why are we seeing it in sentiment? Is it next going to show up in more of the spending data?
Traditionally it has, but maybe it's different this time. I know it's dangerous to say that, but I think the pandemic changed a lot of things. Look at travel and dining and experiential spending like concerts and sporting events. I mean, that's all surging right now. I think there is this kind of you only live once sort of attitude that a lot have embraced moving on from the pandemic. So
YOLO, yeah. People
are rather compromising elsewhere. They're pulling back on physical goods, not experiences.
That, Neil, is the perfect segue to talk about your picks, because it's not like you're, out there banging the table on Live Nation. That might be too big of a cap. But you're talking about consumer goods. You're talking about Dick's and Casey's and companies like that. Why?
Because I think the consumer's in very good shape. I mean, if you just look at the numbers and looking at what Ted was just saying, I mean, you're talking about $17 trillion is sitting in the federal depository banks, of which are sitting in $4.5 billion or just in savings and checking accounts. There's a tremendous amount of money out there. There's a tremendous amount of money on corporate balance sheet. What's essentially affecting the consumer right now, if there's a problem with consumer sentiment, is just the headlines, is AI taking over, artificial intelligence. That's all we talk about. But, when you look at it from my standpoint, it's called artificial for a reason, okay? And people really have the money to spend. That's why I like Casey's. It's so simple. It's so straightforward that they're in approximately 8 states, and they're making a ton of money, and they're selling their 5th largest pizza dealer in the nation.
Why is it that, so when we look at, for instance, Dollar General, Dollar Tree, even Target, these are some of the worst stocks in the market this year. Is that idiosyncratic, or does that have some kind of information about how the rest of these names, which are smaller but somewhat similar, should be doing?
Well, I think, we talk about inflation. Food inflation really took off in the last 2 years. And it's stabilizing now, but it's not going to come down. So we can get commodities to come down, but what we buy at the grocery store is here to stay, and hopefully only goes up a couple percent a year. That's why you see the lower end stores doing much better than a higher end store would do in this marketplace anyway.
Ted, what would you be watching for as a sign the consumer is cracking, or that, what are some of the companies maybe exposed by being too much out on the credit card limb, for instance, if that's one of the first places people start to pull back?
Credit has started to tighten a little bit, but not all that much, to be honest. I mean, Equifax reported only a 1% drop in originations for credit cards in the first 6 months of this year off of last year's record pace.
Wow.
I think the job market is a huge indicator. I mean, that's the biggest indicator of whether or not people can pay their bills. And I think back to that sentiment point, it doesn't feel great because inflation's gobbling up your wage gains. But at least the vast majority are working and making more money. And I think that's where people are keeping up. Now, not everybody. I mean, sadly, lower incomes, lower credit scores, the cracks are starting to emerge. But by and large, I think the data is more positive than the sentiment.
As a final word, Neil, is there anything that you would be avoiding in this environment when you're looking through the stocks and sort of saying, OK, I think this segment of the consumer or the economy is hanging in there? Is there anything you feel a little less certain about?
Well, I try and stay away from thematic companies.
Like artificial intelligence.
Yeah, artificial intelligence, and you can get into Tesla. You can get into a lot of different ones that get a cult behind them, AMC, whatever, GameStop. If you buy real quality and hang on to it, you have to be patient, but you'll be able to play again if something goes wrong.
All right, gentlemen, we'll leave it there. Thank you both, Neil Hennessy and Ted Rossman.